Mark-to-market, or fair value, is an accounting standard that is used by investors to give them transparent and relevant information about where to spend their money, where to allocate their capital. And it just means that it's the price that is received when you sell an asset, or paid when you transfer a liability, in an orderly transaction between market participants on a measurement date. The rap against mark-to-market as a cause of the financial meltdown of 2008 is that it caused asset write-downs. Those write-downs triggered margin and regulatory capital calls. Those triggered more selling, and now you're selling in a distressed market because the healthy participants know something's up and they're staying the hell away. You have decreased liquidity. With decreased liquidity, you can't loan. You've got a liquidity spiral. It's interesting, I found it interesting to learn that mark-to-market actually came out of the savings and loan crisis of the 1980s, and that was where the savings and loans were using historic accounting standards to hide the fact that their portfolios were getting killed by the interest rate increases. They were paying more for deposits than they were getting on mortgage loans. And historic accounting standards, meaning you show on the books what you paid for the asset, came out of the reforms from the Great Depression, where regulators were trying to address the issue of financial statements that were essentially imaginary. To get at the bottom of this question of whether the mark-to-market accounting standards caused the financial meltdown, SEC staff looked at a representative sample of insurance companies and broker-dealers and GSEs and banks. And they found that about 45% of their assets were marked to market. A significant number, but still a minority. But only 15% of those marked to market assets actually caused a change in the income statement. What was wrecking everybody's financial statements wasn't marked to market, it was the economic slowdown, it was the decrease in home values, and the increase in default rates. What's more, investors like mark-to-market. They know it's imperfect, but killing mark-to-market is like killing the messenger. It didn't create the losses, it just exposed them, it brought them to light. Certainly, accounting standards bodies are going to have to address some of the issues with mark-to-market. What is a market? What's a distressed sale? What's a forced sale? And also, at some point, we're going to have to look at the conflict between the transparent and neutral information that investors demand, but the prudential oversight, aka the regulatory capital, that regulators want.